The regulatory landscape for crypto changed dramatically in 2024, and it's not slowing down. The EU's MiCA regulation became fully enforceable in December, requiring service providers to obtain authorization by June 2026. The UK FCA announced exchanges must implement real-time transaction monitoring by October 2026 or face fines up to £5 million. The SEC filed enforcement actions against 46 firms, collecting $4.7 billion in penalties. Japan mandated stablecoin issuers hold yen reserves in domestic banks by April 2026. Welcome to the Crypto IQ. Today we're breaking down everything you need to know about the 2025 regulatory landscape, regional regulations, taxation changes, DeFi and stablecoin shifts, positioning strategies, and an investor action plan for the next 18 months. The European Union's MiCA regulation establishes the world's most comprehensive crypto rulebook. Service providers must segregate customer assets, maintain capital reserves equal to 3% of assets under custody, and publish quarterly reserve audits. The framework distinguishes between asset reference tokens backed by baskets of currencies, e-money tokens pegged to single fiat currencies, and utility tokens providing network access. Issuers of asset reference tokens exceeding €5 billion in circulation must comply with banking-level capital requirements. The regulation prohibits algorithmic stablecoins without reserve backing. United States regulation remains fragmented, but consolidation efforts advanced significantly. The SEC classified 68 tokens as securities requiring registration. The CFTC asserted jurisdiction over spot Bitcoin and Ethereum markets, establishing position limits for traders exceeding $10 million in holdings. The Financial Crimes Enforcement Network implemented the travel rule for crypto transactions above $3,000, mandating exchanges collect and share sender and recipient information. Proposed legislation would create a single framework, distinguishing between securities, commodities, and payment tokens based on decentralization metrics. The United Kingdom created a bespoke framework under the Financial Services and Markets Act 2023. The FCA designated crypto as a regulated activity starting January 2026, requiring all exchanges, custodians, and wallet providers to register or cease UK operations. Capital requirements start at £100,000 minimum for firms holding under £1 million in customer assets, scaling to £1 million for firms exceeding £50 million in custody. Asian jurisdictions implemented divergent approaches. Hong Kong launched a retail crypto trading licensing regime, approving 9 exchanges to serve retail customers with investments capped at 10% of net worth. Singapore maintained its institutional-focused framework, restricting retail advertising while enabling licensed exchanges to serve accredited investors. South Korea passed legislation requiring exchanges to partner with domestic banks, maintain 80% of customer assets in cold storage, and purchase insurance covering 100% of hot wallet holdings. UK taxation rules underwent substantial revision under HMRC guidance published in November 2024. Capital gains from crypto disposals face standard CGT rates of 10% for basic rate taxpayers and 20% for higher rate taxpayers, with the annual exemption reduced to £3,000. HMRC clarified that each crypto-to-crypto trade constitutes a taxable disposal. DeFi yield farming rewards are classified as income taxable at standard rates ranging from 20% to 45%. Staking rewards receive income tax treatment when tokens become available for withdrawal. The reporting burden increased substantially with HMRC requiring detailed transaction records including timestamps, exchange rates, wallet addresses, and counterparty information. UK exchanges must report customer transaction data directly to HMRC starting April 2026, eliminating the previous reporting gap. United States enforcement intensified through expanded Form 1099 requirements. Starting tax year 2025, brokers must report gross proceeds from crypto sales, cost basis, and gain or loss on Form 1099-B. The wash sale rule doesn't currently apply to crypto, but proposed legislation would close this loophole starting 2026. European Union member states implemented the DACE 8 directive, requiring automatic exchange of crypto transaction information between tax authorities starting January 2026. This creates comprehensive tracking of cross-border crypto movements. DeFi protocols face regulatory uncertainty as authorities apply existing securities and banking laws to decentralized systems. The SEC's enforcement action against Uniswap Labs in April 2024 alleged the protocol operated as an unregistered securities exchange. The complaint argued that front-end interfaces, governance token holders, and protocol developers all bear regulatory responsibility. European MiCA regulations explicitly cover DeFi protocols offering services to EU residents, requiring protocol operators to register regardless of decentralization claims. Protocols responded by implementing geographic restrictions blocking EU IP addresses. Stablecoin regulations crystallized around reserve requirements and issuer liability. Circle's USDC complied with MiCA by holding 100% reserves in EU banks and conducting monthly attestations. US stablecoin legislation established a framework requiring issuers to maintain 100% reserves in cash, short-term treasuries, or central bank deposits. Issuers exceeding $10 billion in circulation would require Federal Reserve oversight. Geographic diversification across multiple jurisdictions reduces concentration risk. Transition to compliant platforms before mandatory deadlines avoids forced liquidation during high-volume migration periods. The February 2024 Binance geographic restriction affecting 500,000 UK users created £47 million in elevated withdrawal fees as users rushed to transfer assets. Documentation infrastructure must capture transaction data meeting regulatory requirements. Purpose-built tax software like Coinly or Crypto Tax Calculator costs £50 to £400 annually but automatically generates compliant reports. The cost savings exceed software fees for anyone executing more than 20 transactions annually. Verify each exchange's licensing status through official FCA, SEC, or local regulator registries. Implement automated tracking connecting to all exchanges and wallets via API. Review holdings on exchanges facing regulatory uncertainty. Download complete transaction history from every exchange quarterly. Before March 2026, verify every exchange holding your assets maintains proper licensing. Transfer assets from unlicensed platforms to registered exchanges. Implement automated tax tracking by April 2026 to capture full tax year data. Review DeFi positions for regulatory exposure. These regulations aren't theoretical future concerns. Implementation dates are set, enforcement actions are underway, and non-compliance carries financial penalties exceeding the cost of proper preparation. The FCA issued £12 million in fines for crypto-related violations in 2024, HMRC collected £150 million from crypto tax enforcement. The choice is between preparing for compliance before deadlines force rushed decisions, or waiting until enforcement eliminates favourable options. Comment below. How are you preparing for 2026 regulatory changes? Which compliance challenges concern you most? Subscribe to the Crypto IQ. Next, we're examining another structural shift, where understanding regulatory mechanics determines who profits from institutional adoption and who gets left behind by enforcement. We'll see you in the next deep dive.